Hello and welcome to another episode of Full Court Finance here at Zacks. I'm your host, Ben Rains, and today we're breaking down Under Armour's fourth quarter and fiscal 2018 financial results, and then we're seeing what might be next for the sportswear firm. But before we do that, I want to say, remember, if you have any questions or episode suggestions, please feel free to shoot us an email over at podcast@zacks.com. Also, make sure to subscribe and leave a review wherever you listen to your podcasts. So Under Armour reported their Q4 results last Tuesday. So it's almost a week dated at this point, but it's still very relevant for anyone who's a listener of this podcast. And just Under Armour is a very unique company in this sports retail market. So it's something I really like to talk about whenever I get a chance to. So their shares surged nearly 7% last Tuesday after they surpassed fourth quarter earnings and revenue estimates. So they reported adjusted Q4 earnings of 9 cents a share, which topped our estimate of 4 cents a share. And then on top of that, they saw their international sales climb by 24% to touch just around $400 million. And then they saw their European, Middle East, and African markets, their sales jump, Asia Pacific jump. And then they did see a decline in Latin America, which wasn't a great sign. But overall, their international revenues expanded well and accounted for 28% of total revenue, up from 24% in the most recent quarter, Q3. And then in terms of some things that weren't necessarily the best, they did see their apparel pop 2% overall, and then they saw their Q4 overall revenues climb 1.5%, so that topped our estimates. So they got to $1.39 billion and just passed our estimates, like I said. But this, however, marked their lowest top-line growth in all of 2018, and more specifically, North American sales dropped 6% this past quarter or so in Q4, which is never a great sign, and this came on top of the year-ago quarter where their sales were down 4.5%. So they were down 6% from a quarter a year ago that they were already down from the year-ago quarter. So not great signs for Under Armour's biggest, most important market, and it especially isn't good at a time when its rivals Nike and Adidas are still performing very well in North America. For instance, Nike's North American sales climbed 9% last quarter, and then overall, Under Armour has now reported year-over-year sales declines in North America in 5 out of the last 6 quarters, in 6 out of the last 8. So as I mentioned, that is really not a great sign for the company. They're in this transition period where they're trying to limit their inventories and streamline all of this. They're trying to revamp their whole business at this point, but over the last 2 years, they've really not been able to turn things around in what is still by far their most important market. Accounts for about 25% of their total sales every quarter. So as I mentioned, that'll be really interesting to watch to see what they can do in North America, and we'll get into a little bit more of that near the end of the episode. But I wanted to then just talk about the rest of the quarter and the rest of the year and kind of just show you some more of their results, and then we'll get into what we think was really going on. So on top of their North American decline, their footwear sales also fell 4%, and their direct-to-consumer revenue came in flat at a time when everyone in the retail industry and the sportswear industry is seeing, I shouldn't say everyone, when everyone is hoping to see big direct-to-consumer increases, they're really pumping out as much direct-to-consumer business as possible. So not a great sign that Under Armour is coming in flat in that quarter. And then let's look at just some quick 2018 full year projections before we get into what we think was really going wrong for the company, or what I think was really going wrong for the company this past year. So overall, their revenues were up 4% in 2018 to $5.19 billion. Their wholesale revenue was up 3%, and their direct-to-consumer business was up 4%, and it accounted for roughly 35% of their full year revenues. So, 4% growth is better than flat, but I think investors and other companies would have, or analysts would have probably expected something way bigger, maybe 10% direct consumer sales increase, especially when they're not coming from a huge giant base from the year ago period. So interesting to see what they can do with that going forward. And then North American revenue overall for the year was down 2%. International business was up 23%, driven by growth in Europe, the Middle East, Africa, and then the Asia Pacific region. And then overall apparel was up 5%, and footwear was actually up 2% for the year. And then their accessories business is a very, very small business that maybe they phase out eventually, but that continues to decline. That was down 5% for the full year. And then their gross margin came in at the same as it did in 2017 at 45.1%. So maybe investors would have liked to see margins improve, but during this restructuring, at least it didn't get worse. So some positives and some negatives there. And then looking ahead to the first quarter of 2019, Under Armour executives forecast that revenues will be flat to slightly down from a year ago. And then they also expect another decline in North America. So we could see now 7 out of 9 quarters in a row, which is really not a great sign. And then they see the North American decline being offset by some overseas gain, hopefully. But as I mentioned, that's still signs of trouble for the long run. And then for the quarter, Under Armour expects to break even, with higher profit margins being offset by lower direct consumer sales and more off-price sales as well. And then in terms of fiscal 2019 as a whole, Under Armour executives maintained their guidance they gave, their revised guidance they provided in December, which is expecting between 3% to 4% revenue growth. And then they also expect to see flat sales in North America, and then low double-digit growth in its international business, which might disappoint Under Armour investors at this point, since low double-digit growth is a huge downturn from 23% in the full year 2018, and then a big downturn from 2017 there as well. So once again, there's just not all these great signs pointing to this huge turnaround that Under Armour executives have been talking about now for 2 years. So we're going to get into what's really going on, and then kind of speculate a little bit about what could be going on with the future of Under Armour. So as I alluded to just now, they've been restructuring company operations to cut spending, improve inventory, streamline product offerings. They have cut a bunch of jobs over the last year and a half or so. And this real big turnaround initiative started in the summer of 2017. And then in 2018, they recognized $204 million in restructuring costs after the company had called for between $200 and $220 million in 2018. And it's really continued to offer its performance-based footwear and apparel at a time when the industry, and obviously fashion is always changing and cyclical, but in the sportswear industry, its big rivals, Adidas and Nike, are able to offer their performance-based gear as well as this new trend of athletic wear that transitions into more casual wear, this athleisure phrase that's now become widely popular everywhere. So the company is committed to this sportswear where it's performance-based, and we'll see if that ends up paying off for them in the long run. But as I mentioned, their rivals can offer both, where they're only offering one. Nike has the performance gear, Adidas has performance gear, but they also have that cool factor. Nike has the sponsorships of now the NBA, the NFL, and Major League Baseball, which they took over when Under Armour backed out of the deal they had originally signed with Major League Baseball. And then Nike and Adidas are also both giant players in the world of international soccer, where Under Armour has a very, very, very minute presence at this point, which is definitely holding them back no matter what anyone says in terms of global expansion, because soccer is still by far the most popular sport on a global stage. So if your sports company an international market, has nothing to do with soccer. It's just going to be a little bit harder of a pitch there. And this is something I've also mentioned on the show before, but I think it really just, in terms of, you can talk about money and growth, and obviously there's a big difference between Nike and Adidas and Under Armour in terms of how old their companies are and how expansive they are at this point, because Under Armour is much younger. But in terms of these companies, they've both been able to grow their presence online for about the same amount of time. It's not like one company had a huge head start in terms of growing their profile on the social media platforms, which have now become a huge place where people can shop directly from their phones, and younger people are doing it way more often than most people think. And so this sounds a little like too easy to mention their Instagram followers, but it really does help put in perspective how much smaller Under Armour is. When a couple years ago people were talking about maybe Under Armour could, and obviously that was a little hyperbole, but Under Armour could surpass Nike. But at the moment, and I looked these numbers up this morning because they're always changing pretty quickly, Under Armour has just under 7 million Instagram followers, so 7. And then Nike has 85 million Instagram followers. Not misspeaking, huge, massive gap in between Nike, who is by far top dog here in terms of that sportswear world. And then Adidas is at 20, just over 23. Lululemon's almost at 3. So there's a bigger gap, way bigger gap between Adidas and Under Armour than there is between Lululemon and Under Armour. And then even Puma has almost 2 million more followers than Under Armour does in terms of just all their main Instagram pages. And that's just putting into perspective that Under Armour is way closer to this small niche company like a Lululemon than they are to becoming Nike or Adidas. And then you also even have companies like The Gap, who have rolled out 2 athletic apparel brands specifically for men and women. Then you have smaller companies like Outdoor Voices, who's running a very similar business to when Lululemon was on the come up. They now have roughly 10 stores. They're from Austin, Texas. They've opened stores now in New York City, Chicago, San Francisco, LA, Dallas, Nashville, Boston. So they're another brand to maybe pay attention to in terms of this athletic apparel world. But as I mentioned, Under Armour has struggled to break into this athleisure business. They've struggled with their direct-to-consumer revenues and their direct-to-consumer rollout in this Amazon-obsessed retail age. And the bottom line is the stock is still up, though. Like that's the bottom line. The stock is up 24% in the last year. It tops its industry, which is up 19% over the last year. It opened Tuesday at $21.16 a share, which is not too far off its 52-week high of around $25 a share. So the stock is doing well this past year, and it's really been, in the past year and a half or so, it's really been a trader's stock. It's the company's showing some signs of life after a pretty massive downturn, but it's not the long-term investment that most average investors would probably look for at the moment, at least in my opinion. Because on top of that, Under Armour stock is down 23% over the last 5 years, which is way below its industry's average climb of 48%, and then looks really small in comparison to Nike's 124% climb. And even Lululemon is up almost 200% over this 5-year stretch. So Under Armour has come down off its highs in 2015 and tumbled and able to now just kind of edge its way back into where, if you've had it over the last year and a half or so, it's been a solid stock for you. But long term, it's a little unclear where they're going, especially since they're currently trading at 59 times forward 12 months Zacks consensus EPS estimates. So that's their forward PE based on our earnings estimates, which marks a massive premium to its industry's 20 times and Nike's 28 times. So that's where some of the technical analysis is at this point. And as I mentioned, the stock's done well over the last year, but it's more of someone who's going to be actively trading this stock based on momentum than thinking this is a real great long-term investment at as my opinion at this point. And then we have to remember that fiscal 2019 could even turn out to be a little worse. Under Armour executives are maintaining their lowered guidance from December, but with them expecting North American sales to be flat and down again in this first quarter, it wouldn't be too much of a stretch to think that they'd kind of lower these full year estimates again. So we'll see what goes on there. And then I want to close with a little bit of just a longer quote from Kevin Plank, who is the CEO of Nike. So this is from their earnings call, and it kind of just shows where Under Armour is in terms of, he was asked by an analyst what he thinks Under Armour is doing to address this athleisure market and how they're going to navigate being a performance brand where one of their best offerings and most notable offerings is something from Dwayne "The Rock" Johnson, where it's all based on workout gear. So this is a part of Kevin Plank's longer answer to a question about where he sees Under Armour as a business and kind of as a brand at this point. So I think that you've heard us say incredibly clearly that we're going to double down on performance. You've heard Patrick, which is their CFO, and all of us give this. We believe what may be perceived as our weakness for us today is actually going to be our greatest strength. We understand where the trends are. We understand what people are saying. We get athleisure in some of that movement, but we believe that Under Armour was born on field as a performance brand, technical in its nature. What we do and how we do it. This is like a little bit of a jumbled quote. So this was him off the cuff, and the ability for us to go after and really be able to utilize all of the things that we've implemented over the last couple of years, but have a sharp point. So basically, he goes on a little bit longer. He says that the world doesn't need another version of a brand that may be working today. And so what we've seen is that, especially in the cyclical nature in our industry in general, so we want to be sure that going forward we can be in a really great position where they're gonna own this performance space while everyone else is going to athleisure. So we'll see if that pays off in the long run. But it seems like an answer that maybe some investors might be happy with, and I've talked about this before, that they can be this performance company that they started as, where they were selling you undergarments kind of that were sweat wicking, and they can be this performance brand. And it seems like they're committed to be this performance brand, but if that's what they're going to commit to, it's going to be a really hard challenge for them to grow into this much larger business, because it's just a much smaller marketplace for hardcore workout performance gear based equipment and apparel in this modern retail age, especially as sportswear is trending in seemingly the complete opposite direction at this point. But we'll see what happens for Under Armour long term, and it's certainly a company I will continue to talk about. But that does it for another episode of Full Court Finance. Until next time, I'm your host, Ben Rains. And remember, if you have any questions or episode suggestions, please feel free to shoot us an email over at podcast@zacks.com.